Welcome back to another episode of Multifamily AP 360. And today's our guest is Randy Smith from Impact Equity. So, welcome, Randy.
Yeah, Rama, thanks so much for having me on the show. I'm glad to be here.
Awesome. And a little bit about Randy. Randy Smith brings over 25 years of experience in corporate sales and leadership to his role as the founder of Impact Equity. After a successful career in corporate America, Randy turned his focus to real estate investing, becoming a limited partner in 25 passive investments across 12 operators and 8 asset classes. Since launching Impact Equity in June 2022, Randy has helped over 115 investors place 9 million across 17 projects with 6 world-class operators. With a strong commitment to due diligence, transparency, and investor success, Randy empowers busy professionals to achieve financial freedom through passive real estate investments. In 2024, Randy launched Raise Capital Coaching and Consulting to help new capitalizers start their businesses and assist real estate groups in professionalizing their efforts using modern tools and automation. So, with that, Randy, you want to add anything to your background?
No, that's a pretty thorough background, but like the high level is that I was a sales guy who got the itch for real estate and started investing actively, and then shifted over to passive investing because I realized that was a better path for me and a better way to scale. And after getting laid off from corporate America for the second time, I went all in the capital raising space and capital raise coaching space now. I've been doing that for the last 2.5 years or so.
Yeah, we'll coming back to that story.
Yeah.
And before that, we'll touch on like you have invested passively in 25 deals across various operators and asset classes. So how do
Yeah.
you evaluate and select the right projects to invest in, and what red flags do you look out for when considering a passive investment opportunity?
That is the big question. And I will tell you that it has evolved significantly over the years. I'm embarrassed to share this even, but my first one, my due diligence included listening to a podcast, liking the guy I was listening to, and thinking he had such a big platform and such a big beard that there was no way that investment can go bad. So I kind of blindly invested in that first deal. Now, fast forward 5 years, due diligence looks very different. I've got about a 110 point checklist that I go through for every deal that I look at. Apparently, most don't get through probably the first 10 questions that I go through. And, that has a lot to do with track record. How long have they been in the space? I like folks that are generally 2 to 300 million in AUM as a minimum. And I like folks that have never lost investor capital and their current deals are not potentially going to be losing capital. So most recently, I've been spending most of my time looking at current portfolios and looking at those investor updates and looking at their current financials on their current deals to get a good feel how their current portfolio is operating. That's where I'm spending a large portion of my time now. And if they get through those, then you jump into, are these positive or negative leverage? What's the debt structure look like? All kinds of details around that. So
Yeah, got it. Thank you very much. At least share me like top three things you look in any particular project from operator's point of view.
top three things. So I like positive leverage, fixed rate debt, multiple full cycle deals.
Got it. Thank you.
Yeah.
Yeah. So let's coming back to, transition. So you have impressive transition from a successful career in corporate sales to real estate investing. So what inspired you to make that shift, and what were some of the biggest challenges you faced in moving into real estate?
Yeah, I think so. Real estate was always in the back of my mind. It was always something that I wanted to do. My dad owned apartments in Los Angeles back in the 70s and 80s. And I always thought that at some point I'm going to get into that. I had some limiting beliefs, thinking that I had to have a certain amount of net worth or wealth before I got into real estate. I know that today is definitely not the case. But I jumped into real estate actively at about 45. And I ran into a lot of the challenges that a lot of people do. I was doing single family, out of state single family investing. I started with turnkey and had a really negative experience. And so I moved over to the Burr strategy where I could have a little bit more control, but it was difficult managing assets across the country with limited experience and expertise. And yeah, just basically got to this point where I realized I couldn't scale that single family investing to the level I would need to scale it to ultimately decrease my dependence on my W-2. So that's when I started looking at the passive investing space. And to me, it was really an eye opener to find out that I could invest alongside highly professional, very large organizations that had built systems and processes in place and had the businesses backing them to create great investment opportunities. So I could get all the benefits of investing actively without having to get my hands dirty. And quite frankly, the results were better because they were much better at operating those assets than I were. Moving into the full-time space where I started raising capital, it was a lot of the same challenges that any new business owner has. It's systems, it's networks, it's strategy and training, scalability, all the same type of systems that people run into. And kind of this, there doesn't seem to be a lot of black and white, and I like black and white. And there wasn't a clear path on exactly what you should do to grow this capital raising business. So that's kind of why I've evolved and started to teach people that process as well. So,
Got it. Yeah, thank you very much. And as the founder of Impact Equity, you have already had significant success raising 9 millions for 17 projects. So what do you believe sets Impact Equity apart from other companies or other capitalizers? And what's been the key to building such strong relationship with the investors?
yeah, so I was in a very unique situation in that I was in sales for 25 years. So I was used to having one-on-one conversations and sharing kind of complex ideas and theories in a very simplified, easy to understand manner, just by being a sales guy for so many years. I think when you couple that with very large Fortune 100, Fortune 200 corporate America experience for many years, I brought that professionalism into a somewhat unprofessional industry and kind of married all those skills with where it was. And transparently, I had very deep relationships with colleagues and clients and prospects that I had been building a database in LinkedIn for 15 years. So when I launched the business, I just announced it to LinkedIn and I raised almost $1 million in a couple of weeks. So
Yeah, absolutely. And thank you. Thank you for sharing that. And also you spoke about LinkedIn automation in my previous capitalizing virtual event. Thank you for
yeah,
sharing that.
yeah.
And transparency and due diligence are two values you prioritize, right? So can you share how you instill these values into your projects and how they have contributed to the success of your investment relationships?
Yeah, so you can kind of look at it from two different standpoints. One is the relationship with the operator, the other with the investors. From an investor standpoint, I think the best policy is just to be an open book, share openly and honestly and frequently and regularly at regular intervals. So I do monthly updates on most of my opportunities, and essentially I'm working with operators that do either monthly or quarterly updates. So I just essentially share those. What I'm finding is when you deal with smaller operators, that communication piece seems to be the piece that kind of slides through the cracks and gets missed. And from the operator standpoint, they think it's more important to focus on operations and drive, the value on the assets, when in fact, I personally would rather have an asset that performs less potentially than another investment if I get regular communication. So I've brought that into my thing as well. And, that can be tough. Like I get, Friday nights at 5 o'clock and I get 13 updates that I got to share with my investors. It's not always comfortable to have to stop what I'm doing and change plans to make sure that I get those out to investors within 24 hours. And the same is true with distributions. Working in a fund to fund model, distributions are hitting our accounts all month long, and I immediately have to turn those around and get them to investors. And some people don't like to deal in the fund to fund model because of those challenges. And I can't disagree with them because a lot of fund to fund managers don't operate the way that I do and turn those things around as fast as possible. I think it's important to do that. And the only way to prove that to your investors is to do it. The uncertainty that they have in the front end, you can tell them what you do, you can show them in the system how frequently you do it, but until they actually have the experience with you, they don't know. But actually, as I'm saying that, I'm thinking I should take screenshots of my portals to show how frequently those occur because that could build trust by that.
Yeah.
Yeah.
Awesome. Thank you very much. You touched like fund of fund model, right? So what's your take on fund of fund model versus SPV, special purpose vehicle, and also versus co-GP model? Your take on that?
Yeah, I mean, co-GP we're seeing less and less of that because of the legal ramifications around that with the SEC requirement to show and be able to prove substantive involvement in the day-to-day operations of the facilities and transaction-based compensation, all of those challenges. So I've done, of the 18 projects, I've done 3 co-GP, and those were like 2 years ago. And I solely focus on fund to fund now. And I do that for a number of different reasons, but kind of the primary one is I'm kind of a control freak. So I like to be in charge of the investor experience. So I have my own portal. I don't use other people's portals. I handle all the taxes. I handle all the distributions and updates. And while we're still dependent on the operator to get us the information and the distributions, we can control what that investor experience is like at that point. So I do primarily single asset funds, and that allows me, with the number that I've done, it allows me to provide the diversification to my investors that they are seeking.
Yeah.
And I think it creates a good experience for them.
Yeah. Yeah. So you're investing or your investor investing in like different 7 or 8 asset classes, right? So what are your top 3 asset classes you're focusing?
Yeah, so I'm not in 7 or 8. I personally am invested in those, but I've only raised capital on 3 different asset classes.
Okay.
Um, 80% of which is multifamily,
Yeah.
value add. I did do a short-term rental fund
Yeah.
through a large short-term rental operator, and then I do a debt fund,
Yeah.
which is primarily backed by small to medium-sized multifamily short-term debt.
Got it.
Um, but primarily it is affordable housing, 80s and 90s built. Class B plus is where I like to focus in Sunbelt or Smile State markets.
Yeah, got it. Thank you. So you started raising capital from 2022. So how exactly capital raising space evolved from 2022 to now? So from challenges, opportunities, and overall in investors, returns point of view.
Yeah, so I probably started at the absolute worst time. 2022 was a good year to raise capital, but looking back, those probably weren't the best deals to be raising capital on. Of course, we had all of the challenges with interest rates, which have made it really difficult to find deals that make sense and pencil, and that can get through my due diligence piece. So the portfolio as a whole looks very strong. Of the 18, all but one of them are paying distributions. I do have 2 that have decreased distributions slightly, but the very large majority are paying fairly close to pro forma cash on cash returns for the years that we've had them. Now, what that's going to look like in 2 or 3 years, I'm not sure, right? It all has to do with what happens with the economy, what happens with interest rates, what happens with cap rates on the back end. But when I look at the groups that I'm working with, they're very good operators. So they are executing on their business plan and driving NOI, which ultimately is all we can ask of the operators. There are some
Yeah,
uncontrollables like economies and interest rates that we can't control, obviously.
yeah,
But what they can control is, are they executing their business plan and operating the assets
yeah,
as they initially planned to do?
yeah. Definitely like interest rates, inflation, the 2 biggest factors, and supply demand, right? So these
Mhm,
factors impacting overall, NY, right? So yeah.
mhm.
So thank you.
Yeah.
And would you share any of your best experience so far, either passive or active?
Best experience?
Yeah,
Oh, goodness. That's a broad question. So best experience, I can tell you that the amount of learning and education over the last couple of years has been 10x compared to when I was in corporate America.
yeah,
So just simply learning how to run a business, learning how to scale a business, learning how to hire, virtual assistants and building your own systems and tools. That has been a challenge. In corporate America, All the systems and tools are handed to you and paid for. So having to, understand and manage cash flow has been an interesting process. And, this idea that you can literally do anything in this space, but you can't do everything.
Yeah.
So the most limited resource you have is actually your time, and deciding where to spend that time is probably the most critical piece.
Yeah. Thank you. So any one skill that you learned in last 2 years played major or created most impact in your, business life?
I think it's been the due diligence process. So continuing to refine that due diligence.
Yeah.
I mentioned early on, I've got a 110-point due diligence. That used to be like a 60-point due diligence process. So each deal I do and each partner I work with, I find new questions I need to keep asking and digging into. And we can only underwrite deals to the level of experience and expertise that we have. So we just need to continually be growing that.
Awesome. Thank you. So would you also share any challenging experience?
Well, yeah, so it's interesting. Spending the time that you need to spend with operators to do due diligence at times can add expectations, I think, on their part. And it can be challenging to spend weeks with an operator doing due diligence and vetting them and walking properties and digging into underwriting and, asking all of the questions to cover the due diligence checklist. But the reality is most deals don't work, and you've got to step away. So it's managing those relationships and the expectations to make sure you're not, you know, you've got to be a good partner as well. So not wasting their time and making those decisions quickly, I think has been a big challenge. And, personally, a portion of my personal investments have not gone as planned. So I'm a little gun shy, and I'm probably a little too critical. And, here we are coming to the end of February, and it's been 2 months since I've had a deal. And I've vetted a ton of deals in the last couple of months, and it's hard for me as a sales guy who wants to sell to not have a deal, but it's better to not have a deal than to have a bad deal.
Yeah.
So,
Yeah. Totally agree on that one. Yeah.
yeah.
Yeah. And also you launched your, coaching program Raise, right? Capital raising for new investors. So
Yeah.
would you share a little bit more about that? So how exactly they will benefit, from joining that program?
Yeah, so it really falls into two or three different buckets. So I do one-on-one group coaching or pre-recorded webinar video coaching. And I take my students through the RAISE strategy. It's the acronym I put together for my capital raising process. And it's R stands for relaying and refining your story. So tailoring your story to your investors, and then identifying your avatar, like really digging into your specific target avatar. A lot of people think that I'm gonna go as wide as I can, cast a wide net. But what we find is the more refined and the more niche down you are in your avatar, the more you're going to connect with those people. So we've got the R, which is relay your story to your avatar. The A is attract through LinkedIn. So I've spent 15 years working in LinkedIn and building databases there. So I teach folks everything that I've learned in LinkedIn and then walk through automation tools like the ones that I've shared on your previous training. The I is that due diligence process. So identifying partners. I bring people not only through this process of finding the best operators to partner with, but also individual capital raisers to partner with them as well, because that's a big piece of what we do. We're seeing this trend of the mega funds or the army of fund managers, whatever you want to call them. So as you start to partner with other folks, these are 5-year marriages. So whether it's capital raising partners or operating partners, that due diligence process, I take them through that as well. The S is structuring your fund or your raise. So what type of price or fee structures? Do you do blind fund? Do you do an A-vestor type, customizable fund to fund, SPV, syndication? What I find is most people get into the space, maybe not just traditional capital raisers, but operators that are growing. They can do a lot with just simple promissory notes. Like they probably have 10 or 15 people in their network that can write $1 million check. Is a really simple way to raise capital without having to get involved with the expense of doing syndication. And then finally, the E is just engaging with CRM, investor portals, and email marketing. So we bring them through that full piece, either in one-on-one or group or online. And then what I find is it's two type of avatars, either that new or newer capital raiser that just needs help holding hands through this process. A big piece that's missing, I think, in a lot of the masterminds is that done with you process, like helping hold their hand. But then there's this other group of growing operators that they'll go through the training and say, this is great, I need to do all of this, but can you just do it for me? So that's where the consulting has evolved from there as well.
Yeah,
So,
awesome. Awesome. Thank you very much. So, how exactly you're planning for next 12 months or 36 months from, overall cap raising or any other activities?
yeah, so my plan is the same as it was from the day that I launched this. It ties very closely with my own personal investing goals, which are to have 4 to 6 operators that I stay very close to across various asset classes and various business models. So I can personally have diversification in my own investments and then share those investments with my investors. So give them diversification across asset class, geography, business plan, vintage, all of the different diversification channels, and then continue to help other capital raisers do the same.
Awesome. So, any personal habits that are helping you to be successful?
Great question. Oh boy, like how deep do you want to go? So I think it all starts at the individual. I have a very specific morning routine that I go through, prayer and meditation, healthy meal, exercise. So it's very similar to the strategies that you hear a lot of people talk about. But healthy eating, prayer, meditation, good exercise is kind of at the core of everything. As I've started to get more and more, I guess I would say, fragmented or multi-directional in what I'm doing, time blocking has become incredibly important to where I plan out my week. Well, first of all, I review the previous week, cover my wins and my learnings, and then I set the stage for the next week with time blocking where the priorities are. And that's just been inevitably when I start getting frantic or start getting a little chaotic, I just come back to time blocking, and that always seems to solve the problem.
Awesome. And would you also share any book that impacted you?
Yeah, I mean, there's a ton. Who Not How is a great book. We hear a lot of people talk about The Gap and the Gain. I really love that book, focusing on how far we've come versus how far we have to go. Those are two, like, I'm actually reading a book on webinars because I'm doing a webinar strategy called One to Many,
Yep.
which that actually is a fantastic book. It doesn't look very good, like the front of it doesn't look very good, but yeah, I mean, I read 2 to 3 books a month, so there's always a new book on the table.
Awesome. Awesome. So, how can listeners can connect with you, Randy?
Yeah, easiest way is through impactequity.net is the capital raising business. If you're interested in capital raise coaching, it's raisecapitalcoaching.com. I've got a podcast called The Gentle Art of Crushing It, where we have 254 episodes, and I spend a lot of time on LinkedIn. So those are the best ways to meet me.
Awesome. And thank you very much, Randy. Thank you.
Thank you. Thanks for having me.
Sure.